Welcome to our Friday market updates. And my name is Thomas Holloway. I'm a portfolio management at Janus Capital, and I'm joined today by CEO Wayne Wachell. Hi, Wayne. Thanks for joining.
Good to be here.
I want to thank all clients for tuning in again this week, and an additional thank you to our production team, in particular Carol Faraz, for putting together these videos each week, as well as research support from the Janus investment team. So we just want to highlight that there's a team behind these things, and we're very grateful to work with all of them. To kick it off, so today's January 15th, and Wayne will start as usual with what were the highlights of this week? What did you notice?
Well, the market was flat, but there was a lot of things going on internally, and I'll talk about those. The events this week were driven by the expectations of the Biden stimulus plan. It was announced, 1.9 trillion. And dovish Fed speak, and that really got things going. Technology lagged a bit, and there's some concerns I have on technology. We'll talk about in a few minutes. But that was sort of the market. And so internally, value did well, technology came off, bond rates were up, then sort of sideways by the end of the week. Small cap did better. So it's more of the risk on value type reopening trade did better this week than the shutdown trade, if you will.
Great, thanks a lot. So, I mean, maybe just connect that a little bit more to how it affects our clients and our portfolios.
Well, over the past 3 months, we've been rotating from technology, the winners of the pandemic, to the reopening winners in terms of moving towards more the economic sensitive, the financials, industrials, materials, the reflation type trade. And we did more of that through the course of this week here in terms of expanding our weights in some of these areas. We also rotated some of our monies back into our dividend strategy, which we've been underweighting. We've taken money away for the past almost 2 years. We think it'll do well with the value trade coming on with the reopening. We also took some money off some of the social media companies like Facebook. We have some concerns there with all the censorship and deplatforming. We don't think it's a political issue, but we think it's actually a business issue, and that's our concern. When they're alienating half the population and spawning more competition, and if the Republicans ever get into power again, they'll go after them and make them lose their clause 230. So we think it's a business issue, and so the course of the week they've been down. Twitter was down 10%, Facebook was down 5%. It's caused us some concern that they're going to lose users and spawn competition. It's just not good for business the way we see it, and and capitalism, I would say. So,
great, thank you very much. One of the items you mentioned off the top was dovish Fed speak. So I'll just follow up a little bit more on that one. In particular, Federal Reserve Chairman Jerome Powell spoke yesterday. Just like us, he's talking from home. I saw in the background his kitchen. But could you expand a little bit more on that? And when we think about central banking, just as a reminder, the mandate is steady inflation and full employment, which sounds old-fashioned with all the things that central banks also do these days. But where do we stand, and what did he have to say?
Well, there was concerns going in that they would taper, they would stop the buying of bonds. But he gave us clear guidance even at the end of last year that inflation is not a concern. I think their top priority is to get unemployment down below 4%. I can't see them doing anything in terms of tightening or tapering until they get unemployment down below 4%. And really, that has the biggest impact on equity of wages and helping the lower income areas. So I think he just continued that same narrative. He's going to be there. They're going to keep the plan in place. So I don't see any change in probably till 2022. And I think inflation is going to have to go above 3%.
Yeah, that sounds right. I think what I heard the same thing is kind of just don't worry, we're not changing anything. I think some commentators might have been getting ahead of themselves that it was time for the Fed to start doing something, and he was basically like, not even close.
We're not even thinking about thinking it, as he said.
Maybe just to bring it over to Canada a little, we can talk a bit about the Canadian dollar. Generally speaking, Canadian dollar has been quite strong lately, up to about 79 cents US from, about 10 cents higher than the lows in March. What's going on there, and how do you think about that in terms of portfolios as well?
Well, number one, the oil has been going up, and that's always there's a high correlation with oil and the Canadian dollar. That's one of the big factors. As well, I think just expectations of a global recovery this year, and probably a global synchronized recovery, would help Canada. Canada's export sector is very important to it, obviously. So it's a global recovery will always help Canada, and our currency outperforms during those kinds of periods. So that's what's going on there. It'll also keep a lid on our inflation. As the currency goes up, we can buy foreign goods at lower prices. So it's good for inflation. Maybe not as good as for our trade longer term, but oil going up, and oil seems to have momentum here. They could take the dollar a bit higher. I'm not sure how far it's going to go. It's had a nice run here already. I could see it going to maybe 82 cents through the course of this year. I'm not sure how much far it would go beyond that, but it still has some momentum here and could go higher.
Yeah. Great. Well, that's all the questions we have for this week. Thanks, Wayne, for your time, and thank you so much to the viewers. As always, if you have questions that you'd like to see featured next week, please reach out to your portfolio manager, and we'll see you next week. Thanks again.
Thank you.